Now let's see what are the types of costs. We'll cover the following types of costs: the accounting cost and the economic cost, outlay cost and opportunity cost, direct or traceable costs, and indirect or non-traceable costs, and finally the fixed or variable costs. Now let's see what are accounting costs and what are economic costs. Accounting costs are nothing but the expenses, the costs which we incur in our daily routine life. In terms of production, those are the costs that we pay for. For example, the salary of the workers, the interest paid on loans taken, the rent paid for the premises hired, repairing of machinery, postage and telegram expenses, expenses incurred for purchasing raw material. All these expenses are accounting costs. Now, why do we call them accounting costs? Is because we tend to account for these costs. In our books, we tend to record such costs. So, are there any costs which we do not tend to record? Yes, there are, and those costs are called economic costs. I'll come to economic costs later. Let's finish the accounting costs first. Accounting costs are those costs, as I said, which we record in our books, for which we have an account. We tend to add up all these costs and come out with the total cost. These costs are also called as explicit costs. Now, why are these called as explicit costs? Because it is very easy to understand, it is very easy to see, it is very easy to perceive these costs. When I pay salary to my worker or wages to my worker, I can see that I am incurring some cost. It is easy to conceive such costs. However, there may be some costs for which I may be incurring expense, but it may not be striking me that I am actually incurring those costs. So, such costs are not recorded in the books because as humans we do not perceive such costs. Only those costs which we can see, which we can understand, and for which we actually pay are called as accounting costs. And as I said, accounting cost is also called as explicit cost. So now, what are the implicit costs? Implicit costs are those costs which do not burden the cost bearer. A person who actually bears the cost but does not feel the pinch. They are not expressive enough to make their presence felt. For example, if the owner, let's say a person who owns a piece of land and then he sets up a factory on it, and then he employs labor and purchases material for production. So the cost that he will record in his books will be the cost of construction of the factory shed, the purchase of raw materials, and the payments made to the laborers. He will not record the cost of land because he had already owned it. He did not incur any cost in purchasing it. Such costs are called as implicit costs. Now let's consider that person does not set up his own factory, but on the contrary gives that piece of land to some other person, and that other person sets up the factory. Now this person earns rent on that land. He lets it to someone else and earns rent. Now, what happens is, because he's putting up his own factory, he cannot perceive that he's incurring some cost. But this cost, the rent that he has foregone, the rent that he has sacrificed for self production, is the implicit cost. Because land is a factor of production, it should also earn something, and land earns rent always. But since the land is owned by him, he does not give himself any rent. So he does not account for it. And normally, this is how we go about costs in our books. But implicit costs are taken care by economic costs, because economic costs are nothing but accounting costs, that is explicit costs plus implicit costs. Economic cost means all those costs which you can see, which you actually pay for, which you incur, plus those costs for which you may not be paying, but you should have paid. You should be paying actually. It's like a person who works in his own office, who works in his own shop. He does not pay salary to himself. However, if he had worked at some other person's office, at some other person's shop, he would have gotten salary. So now he is foregoing salary so that he can do his own business. So the part of salary which he is sacrificing is called as implicit cost. So these are the costs that actually are incurred in the economic sense. But in accounts, they are not recorded, they are not considered as costs. But economic cost includes both explicit cost, that is the accounting cost, and the implicit cost. And in economics, profit means revenue minus economic costs. Now please understand, in accounts we only account for accounting costs. We take the revenue and then we take the accounting cost and then we come out with the profit. However, in economics, profit is not revenue minus accounting cost, but it is revenue minus economic cost. Because economic cost includes accounting costs, in addition to it, it also includes the implicit cost. So the land which is owned by the person who is running his business, the rent which he would have gotten on it is also considered. The time that he has invested into his own business, the salary for that is also considered. The amount of capital that he has invested into his own business and the interest that he would have earned on it is also considered. So all these things which a entrepreneur does for his own business, he does not account for them in the books. But in economics, they are also considered as costs. And economic profit is nothing but revenue minus economic cost. And economic cost includes both explicit plus implicit cost. So this is how accounting profit is different from economic profit, because accounting profit ignores the implicit cost. It does not take into account the implicit cost. However, the economic profit takes into account the implicit cost. One important thing to note here is economic cost also takes care of the profit, because an entrepreneur bears risk. So for bearing risk, profit is the reward. So normally the percentage or the amount of profit earned by other entrepreneurs, other businessmen, in the same field, in the same sector, in the same industry will also be considered while calculating economic cost. So economic cost includes the rent for the land owned by the entrepreneur, the capital invested by the interest on the capital invested by the entrepreneur, salary for the time he invests into his own business, and not only that, but profit as well. The normal profit that he would earn on such business. So, this is how accounting profit and economic profits are different. Outlay cost versus opportunity cost. Now, what is outlay cost? Outlay cost is nothing but the expenditure, the total expenditure that has been made. It is very similar to the accounting cost. It is the total amount of expenditure that an entrepreneur, that an industrialist, that a capitalist has incurred in his business. And such costs are recorded in his books. So when he sums up, when he totals such costs, it is called as outlay cost. So then what is opportunity cost? Opportunity cost is the cost of the opportunity foregone. Let's say you want to do a business and you have three options. First, to invest in the business from your own savings. Second, to borrow money from a bank. Third, to borrow money from your relatives. Now, all these three options will have different costs attached to them. You could have easily invested your savings into some FD and earned interest. Now you are not investing it into the fixed deposits but investing into the business. So it also comes with a cost. Bank will never give you funds free of cost. So again you'll have to pay some cost for it, some interest for it. Likewise, relatives will also charge you some interest. Now, all these three options have cost attached to it. Whichever option you choose, the cost of the next best option is called the opportunity cost. The cost of the opportunity foregone is called the opportunity cost. For example, if you choose to borrow from the bank, so you had the opportunity to borrow from your relatives. The cost of that opportunity that you have foregone is the opportunity cost for you. You also had the opportunity to put in your savings into your business, but you again chose to borrow from the bank. So the cost of that opportunity of investing your own money, your savings into the business is the opportunity cost. It is the cost of the opportunity which is foregone, which is sacrificed. And such costs are never recorded in the books because you will never record. If you pay bank some interest, you will record it in your books, but you will never record the amount of interest that you would have paid to the relatives had you borrowed from them. We do not record such costs in the books because you did not choose that option only. It was never chosen. The cost was never incurred. It is only the cost of opportunity that you have foregone. So it is never recorded in the books. For example, the cost of education. Now let's assume that you are a chartered accountant. Now your family members are expecting you to get some job and start earning some money. But you want to do an MBA. So, what do you think is the cost that will be incurred by you? Obviously, you'll incur tuition cost, cost of the institution, that is the admission cost of the books, the stationery, cost of the commute, and some sundry other costs. This is what we generally think. But we fail to understand that while doing MBA, you are foregoing the earnings that you could have made. You could have started earning money. Had you been employed somewhere, had you chosen to be employed somewhere, you would have started earning. But you now chose to go for higher studies. So now you have foregone your earnings, and this is the opportunity cost. No doubt you'll never account it, you'll never record it in your books. Yet these costs are called as opportunity cost. Next is direct cost and indirect cost. Direct costs are also called as traceable costs. Now, why are these costs called as direct cost or traceable costs? It is because these costs are directly related to production, directly traceable from the product. For example, the cost of purchase of raw materials. So, when you purchase raw materials, you incur some cost. Now, is this cost required for production of output? Yes, it is. Unless you purchase material, you won't be able to convert it into finished goods. So, this cost is required for production. So, this becomes our direct cost because it is directly related to production. Again, wages paid for the workers. Do you think payment of wages for the workers who produce the goods is important? Is it required? Yes, it is very much required. Unless you pay wages to the workers, they won't work. And if they won't work, you won't be able to produce goods. So, payment of wages is also a direct cost. But if I tell you the cost of postage, the cost of traveling, are these costs related to production? The cost of marketing the product, the cost of advertisements, are these costs directly related to production? If you do not incur advertisement cost, don't you think you'll be able to produce the goods? Obviously, you can produce the goods because advertisement has no direct relation with production. So, those costs which are directly related to production are called direct costs, and those costs which are not directly related to production, which are indirectly related, which do not have a direct impact on the production, are called indirect costs. Direct costs, direct costs are also called as traceable costs. Indirect costs are also called as non-traceable costs. Let's understand what are fixed costs and what are variable costs. Fixed costs are called constant cost. Now they are called fixed cost or constant cost because they remain fixed. They remain constant. Whatever be the amount of output, they will not change. They will not vary. For example, if you hire a room for rupees 10,000, now it doesn't matter if one person stays in it or two persons stay in it. 3% stay in it, or 4 or 5 or 10% stay in it, you have to pay rupees 10,000 only. Again, at the same time, if you hire a classroom, it does not matter if you teach one student or you teach 10 students or you teach 100 students in it. You'll pay only 10,000 rupees. So, what is happening is these costs are fixed, they do not change with the amount of output, and thus they are called as fixed cost or constant cost. It is important to understand that these costs are called as unavoidable costs. You cannot avoid these costs. Once you have contracted for rent, you have to continue with it. You cannot say, okay, in this month, let's say the contract is for 12 months, and for 2 months you were at some other town or other city. So you cannot say that you were not here, so you will not pay for it. You cannot avoid that rent. You have already contracted for it. So such costs are called as unavoidable costs. Again, interest on loan is also one such cost. It remains fixed. Once you take loan from a bank, it doesn't matter to them if you use them. It doesn't matter to the bank if you use the funds or you don't use. You still have to pay interest. You might use the funds for your business, you might use the funds for your personal use, you might use the funds for investing somewhere else. It is immaterial. You'll have to pay interest. You cannot go and tell the bank that you are not using the funds, so please do not charge me any interest. The bank will still charge you interest. So you cannot avoid that cost. What are variable costs? Variable costs are those costs which go on varying with production. If you increase the amount of output, you will have to incur more cost, and if you decrease the amount of output, you will have to incur lesser cost. For example, if you want to produce more, if you want to increase your production, you will have to buy, you will have to purchase more raw material. Your production is a direct function of raw material. It gets converted from the raw material. So, if you want to produce more, you will have to purchase more raw material. Your production is directly related to raw material. Likewise, your production is directly related to the wages. If you want to produce more, you will have to employ more laborers in your factory, and thus you will have to shell out more wages to them. So, higher the production, higher the wages. Higher the production, higher is the material cost. Lower the production, lower is the wages and the material cost. So sorry, such costs which vary with the production, which vary with the level of output, are called as variable costs.